Welcome to the 3 Edge Week in Review for the week of April 17th, 2023. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and joining me here today, once again, is Steve Cucchiaro, CEO and Chief Investment Officer here at 3Edge Asset Management. This week, Steve and I will be discussing the potential for a debt ceiling impasse and the risk to the capital markets if Congress fails to increase the government's borrowing limit. First, a very brief market update and another decidedly choppy week in the market. Investors digesting corporate Q1 earnings reports and then thinking about what companies are suggesting for forward guidance for the remainder of the year. Both stocks and bonds were mixed, seemingly up one day and then down the next. However, I would say that by the end of the week, the tone in the market seemed to be turning perhaps more negative. Investors are becoming increasingly concerned about signs that inflation is proving to be stickier than hoped, which is prompting remarks from the Fed and other of the world's central banks that they may need to continue to tighten monetary policy, which of course could be a drag on global growth during the remainder of the year and beyond. One area where we're seeing how these downbeat economic forecasts could play out is the recent decline in the price of crude oil in the face of potential weakness in the global economy. So let's get to today's topic. And Steve, as you know, I actually happen to be out this week at a conference. I have a great deal of time speaking with independent RIAs, financial planners, and wealth managers. And from my conversations, it is absolutely clear that nervousness around the risk that Congress is not able to raise the debt ceiling in time is making their clients and pretty much everybody nervous. So why don't we begin by having you explain how the debt ceiling works and what it could mean if Congress doesn't agree to raise the debt ceiling, which will need to happen in the next couple of months.
Well, Fritz, the debt ceiling is a self-imposed limit that we place on our own federal government's ability to borrow. And we hit the debt ceiling in January. And so from January on, the debt ceiling was $31.4 trillion. We hit that in January. And so the U.S. government is not able to borrow since January. Well, we still have been paying our bills. Why? Because the Treasury, you can think of the Treasury as having a savings account at the Federal Reserve Board. And it was quite large, and now it's working down that savings account. And it's employing what they call other extraordinary measures, doing some financial machinations, so to speak, to try to continue to pay bills. But this is very temporary. And depending on how strong tax season is and what the level of tax receipts the government will get, we could find out that the government is out of ability to pay their bills as early as late June. And it could be later depending on the tax receipts, but that's really coming up. Now, I should point out that we are the only country in the world that has this kind of debt ceiling, with the one exception of Denmark, but their debt ceiling is so high that it's deemed that it will never be reached. Other countries that have something similar to debt ceilings automatically adjust their debt ceilings by the growth and the size of the economy. So we're really in a unique position. Because of that, we have had to hit the debt ceiling, and then Congress has had to vote to extend it over 100 times since we've had debt ceilings. And it all began in 1917 during World War I, when before that, Congress, the government had to go to Congress every time it wanted to borrow money, every single instance. And that it's so cumbersome, especially during the World War, that they finally passed a law saying, well, Congress can, the Treasury can go ahead and borrow whatever money it needs as long as it's below a certain ceiling. But then with the natural growth of the economy, we always hit that ceiling, and then Congress gets together. And in almost every case, it happens very quietly and smoothly, and they extend the ceiling. But not this time.
Well, I know you and I have done our fair share in getting those tax receipts up this year. So we have, as you mentioned, we've had these debt ceiling impasses or controversies in the past. So maybe looking back, the last time we had a debt ceiling impasse, and describe what happened, how it was resolved, and how the markets reacted.
Well, in over a 100-year period, it almost always goes smoothly, but I can think of 3 times when we've had some kind of debt ceiling crisis. Two of them got resolved very quickly, but one stands in my mind the most, and that was 2011, not all that long ago. And it was literally a game of chicken between the Republicans and the Democrats. And in that process, as we get closer and closer to the debt ceiling crisis or further into it, the U.S. government lost its AAA rating from Standard & Poor's, which is one of the rating agencies. Never thought that could ever happen. And things were getting so tense. Stocks fell nearly 20%. Interest rates at first rose. Gold rose. People were very, very nervous. Volatility, the VIX index went up to 40, which is a very high number. And then in the last minute, there was a compromise that allowed the debt ceiling to be extended. And the compromise was that they would form a committee to study the issue.
I remember that because I think they started to close the national parks, and that was a big deal, and that was appearing on the news. But yeah, I remember that one. Okay, so I saw a recent report from Goldman Sachs. It sort of gets to what you were just talking about. And they were saying that this year's fiscal deadline will pose a greater risk than it has for a decade, which would harken back to the example that you gave. But so now, as always, my final question is, all right, based on where we are, the risk to Congress not being able to extend the debt ceiling, how should investors think about their investment portfolios going into this situation?
So, Fritz, unfortunately, compromise is not a word that we're hearing very often in this increasingly polarized political environment. Mm-hmm. So big worry is that this game of chicken could be worse and go beyond what happened in 2011. And 2011 was no picnic. So we can't ignore it. We can't just say that reasonable minds will prevail. This could get more and more ugly. And we have to be prepared for that. And frankly, the market is not pricing in that kind of crisis. So I think it's still very important to stay diversified and to stay cautious. There's no guarantee that this won't get worse and that the market won't get hit like it did in 2011. And there's one irony, though, and that is that the safest investments considered by the entire world are U.S. Treasury bills. There's nothing that's been considered more of a risk-free asset than U.S. Treasury bills. And yet, because of this potential debt crisis impasse, it's the short-term U.S. Treasury bills that are in the crosshairs or being held hostage by the politicians who are threatening not to raise the debt ceiling. And so some of the very safest investments that people have, which are money market funds and cash equivalents, some of them do own these same very short-term Treasury bills that are supposed to mature right when the government might be unable to pay its bills. And it's kind of unthinkable. And who would ever put their own country in this situation? But so far, it looks like it could be a risk of some kind. So it's very important to look at the form of cash or money funds that you hold. And there are options. Some hold Treasury bills of longer maturity outside the horizon of when this crisis is destined to happen. So that could be considered safer. Some money funds hold what they call repos, which are obligations of the Federal Reserve Board and not of the federal government. And those can be considered safer. So it's going to require some real sharp review, even of so-called safest investments, to make sure that one can skate through this crisis and not be nervous waking up at night reading the headlines about this looming crisis that politicians seem prepared to run in a game of chicken until the last minute or beyond.
Well, thank you. Thank you for your insight. This potential debt ceiling impasse clearly has investors on edge. So I hope that, our discussion here today will at least inform our listeners as to what could transpire as the U.S. government approaches the debt ceiling in the coming months. And in the meantime, we'll hope that the folks in Washington will find a way to raise the debt ceiling. So that will do it for Steve and me for this week. As a reminder, all our videos are available on our 3 Edge YouTube channel. In addition, all written commentary always available on our website, and that's at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.